Simon Brown. Today we're going to look at gold. I got a disclaimer up front. Anytime before 2020, if you asked me about gold, I would have said, nah. Best time to buy a gold share was when you were closing a short. It was just, to me, it wasn't. It was a relic. And that's maybe because I can remember the 80s when it peaked at about $850 in early 1980, late 1980, early 81, and then basically went downward for the next 20 years until it troughed at some 200, and then now it's been moving higher. That's 1975 to date, just a raw gold chart. You can see, we start off, you can see the spike in the 1980s. You can see the 25 years to get back above it. You can see the US downgrade, the run up into that, the collapse. And then interestingly, the pandemic was good for gold, but it's been what's been happening post the pandemic that really has got gold excited and got gold really moving. So I'm going to take that chart. That goes, as I said, back to 1975. I'm going to take a shorter term chart just so I can overlay because I don't have much data back there. This is 2000 to date. So it's 25 years worth of data. And that's just pure gold. So that's just a buy and hold it, do nothing. But we've got to compare it against things. So then we bring it in against the S&P 500 total return index, and it has massively outperformed S&P 500. In part, you can see the first sort of 10, 12 years of the century, the US markets went sideways after the .com, so there was no return there whatsoever. If we bring it home to local and we put a top 40 on, top 40's kind of matched it. And some of you are saying, okay, but that's top 40 in ZAR. We need to do top 40 in Rand. So there's an ETF which trades in New York, which is basically our top 40, but priced in dollars. And what you can see from that is it obviously pulls it down because our currency's halved over that period. But interestingly, kind of matched the S&P 500, which I think is perhaps the more interesting. The short answer is gold has kind of been doing what it says on the sticker. And here's it compared to the gold miners. There's a ton of miners there. We can see gold kind of sitting in the middle at 1,075. Below it, AngloGold Ashanti, Harmony, Sibanye, and DRD. Sibanye is a weird beast because, of course, they were gold. Now they're mostly PGMs with some gold. And then above it is Pan-African Resources and Goldfields. There is a catch that Sibanye and Pan-African don't have a 25-year history. They weren't around 25 years ago. The point being is that we're suddenly finding ourselves in a space where gold is a hugely important part of a portfolio. And that's what I want to discuss this evening. I want to talk around why is gold important and what does that hold for the future. I want to talk around what, do we hold gold or gold miners and what sort of ratios we put that into. And then I want to also touch on some idea around price targets. Where's gold going? Why is it running? And why is it moving? This is a more recent chart. That's a 5-year chart looking at gold. It is a weekly chart. What you can see is it moved up into this rectangle and then went sideways for pretty much everything, then started to break out. Gold, it runs, it consolidates, runs, consolidates. It looks like it's run again. Last week was an all-time closing high in the weekly candle. That was mostly Friday after Israel started bombing Tehran, and we suddenly saw that moving higher. That's 33,800. It's a little bit, I think it's 33.74 at this point in time. So it's come back a bit, not massively, but there is certainly some volatility there. But let's go through some history of gold first. And so we got to go way back. We got to go back to sort of 4,700 before Common Era. So that's what, 6,700 odd years ago. That's the first time we can find artifacts that are gold. Weirdly, in Bulgaria, I think weirdly the Bulgarians probably don't, but weirdly in Bulgaria, and we don't know much about the mining of it, but we're finding gold artifacts from that period. 31 before Common Era, Egypt was mining gold quite aggressively. 50 before Common Era, we had the Romans mining quite aggressively. 1300s, Zimbabwe, or Great Zimbabwe as was known, was mining gold and in fact trading it on the Indian Ocean trade routes with other African countries north of us and across into China and Asia. And again, we found those trinkets from there. So gold's been around forever. Locally, 1873, Pilgrim's Rest, they found gold, Barberton. Barberton's still in existence. Those mines are still being run. Pan-African Resources runs some of them. And the trick is a mine that was mined back in the 1800s with the technology, they left behind vast amount which they just couldn't get to because of price and technology. There's gold in South Africa, which at the right price we can go and get to, but we also need that right technology. We'll talk about that. We found gold in the reef in 1884, and then we ultimately found gold in Johannesburg in 1886, which is why Joburg exists. Joburg's the only capital city in the world not in a body of water, because we were in a body of gold, which some would argue is more valuable. I don't know, pumpkin seeds and water. When the world ends, your gold bar is not going to help. But certainly, we became a gold country. Back then, we were sort of doing 30% by the end of the previous century, 1899, about 30% of total gold production. By 1870, we peaked at about 2/3 of total global gold production, and now we're at about 4% of that. There are a couple of reasons why we have gone down to 4%. The biggest is that we're now going down 4 kilometers to get gold. And that is a significant challenge. It is an immense challenge, particularly if you're trying to do it safely. Back in the 80s, there would be accidents on our gold mines regularly, and there would be hundreds of dead people when that happened. And there would be literally just a small little thing in the newspaper. It wasn't a big talking point. To be clear, apartheid had played a role in that because of who was dying. It wasn't the mine bosses, it was the mine workers. But going 4Ks down is hard. It is immeasurably hard just to get down there. Then you've got to cool it. You've got to keep it because it's hot down there. You've got to blast tons and tons of rock. Understand, most of these miners have a head grade of about 1.5 to maybe 2.5 grams. In other words, for every ton of rock, they get 1.5 to 2.5 grams of gold. You've got to blow up a lot of rock to get through that. And what we're seeing, DRD has been mining the mine dumps, because in those days they just didn't have the tech. So they were leaving gold behind in the mine dumps that they couldn't get. DRD is getting a gram out of mine dumps, which is significantly easier. So you don't need to go down 4 kilometers of depth to try and get the gold. And we still have, as a country, it's not like we don't have enough of it. I mean, if we go under the Western Basin, there's probably the biggest reserve of gold known in the world. The problem is it's about 6 Ks down, and between you and it is about 1 kilometer of granite rock. And we don't have the tech, we don't have the gold price to do it. So we're not the gold powerhouse that we once were. We still do have significant gold. We're probably more these days, I don't want to say PGMs, but sort of industrials. The manganese and those sort of metals are probably more important to us. But here's a fun fact. The longest continually listed company on our exchange, the JSE, is DRD Gold. It used to be called Durban Roodepoort Deep. The traders called it the Durban Rocket. It has been listed since 1894, I think, was when it listed. So that's 130 odd years that DRD has been listed. And interestingly, it's been listed as a gold miner. It's mined gold the whole time. SAB Miller used to have the record for the longest, but of course they got delisted when they were bought out by Anheuser-Busch. So we go back to Bretton Woods, 1944, post-World War II. Lots of challenges to the world. One of the big challenges is trying to get a global economy working again, both from just a good old-fashioned flow of trade and everything, but also, between what were enemies during the war, etc. And Bretton Woods was 44 countries, and there were a lot of agreements, but what the key agreement I want to talk about here is that the US government would be backed by gold. Their currency, the dollar, would be backed by gold, and other currencies would peg themselves to the US dollar. That was the plan. Now, the one plan had been that there were other options. One would be to start a whole new currency that would be the central one. The other would be for the sterling and dollar to share that global status as reserve currency. Ended up just being the dollar, and dollar was essentially convertible for gold. You took yourself $10 to the Reserve Bank in the US, and they would give you $10 worth of gold. And all the other countries then pegged to the dollar. Except they didn't peg to the dollar. That was a lovely idea. It just wasn't practical, particularly if you were, for example, Germany. It just wasn't, it just couldn't happen. So that kind of fell away fairly quickly. And then we move forward to 1971, where Richard Nixon takes the US off the gold peg. He says, nope, we're no longer going to back our currency with gold. We will own some gold, but we reserve the right to print dollars as much as we want no questions asked, which is pretty much what it's been since then. Governments hold gold via the central banks, but at the end of the day, if they want whatever the currency is, ZAR, RMB, euros, whatever, they go to the printing press and they print it. Weirdly, when finding this newspaper, I forgot all the rest of what Nixon was doing. We've got to remember 1971. Firstly, the US economy was really, really struggling from this peg because it didn't give them flexibility to print. There was huge demand for their currency because they were becoming the global sort of default currency, quite well entrenched by that point in time. And that meant a very strong currency, which didn't help their import-export market. But there was also, you can see there, 90-day wage freezes, et cetera, et cetera. And from there, we went into the oil crisis. Not we, the US went into the oil crisis, OPEC limiting supplies, inflation rallied, and we eventually get to the early 80s where inflation is at 18%. And that is sort of, since records started in the US, that's the highest level of inflation that we've seen, an 18% inflation. What we had seen was Nixon had essentially got his central banker to lower interest rates to try and help him win an election, which he won. This has been 1972, but of course that worsened the situation. And to be perfectly frank, it's what Trump is trying to do with Jerome Powell right now. You know, I want you to lower rates because it's good for my voters, but Powell is saying, yeah, but we've got this nasty thing called inflation. And every time things started to get a little bit better, Gerald Ford did it as well. Every time things started to improve, the pressure went onto the head of the Federal Reserve to lower interest rates, and they ultimately did it. Jimmy Carter then comes along and says, nope, not at all. He got Paul Volcker in and he said, it's your central bank. You need to break this inflation bugbear. So the US had interest rates of 15% at this point in time. It worked. He got rid of the inflation. He got it down. We've pretty much, the US since then has had sort of low to mid single digit inflation since then. And aside from the pandemic of the last sort of since 2000, the US has pretty much managed to keep their inflation around that 2% target level. Then we get Gordon Brown, no relation. He was the Chancellor of the Exchequer in the UK, and he starts to sell gold. So this is a pivotal moment. If we go back, so this is late 90s, 30 years before that, currencies were backed by gold, directly US dollar, indirectly by pegging to the US dollar. And suddenly here, Gordon Brown is like, this is a completely useless asset. We don't want it. And he started selling off their gold in a series of auctions over about 3 or 4 years. He got about $3.5 billion for the 40 tons that they sold. They would do auctions of 50 tons of gold at a time. And this chart's out of date. It says it's worth 16 billion. But that is a gold price of $1,200, so practically it would be worth closer to $40–45 billion of gold at this point in time. It's probably one of the worst trades ever out there, but it didn't stop Gordon Brown becoming PM for a very short while. So apparently if you lose other people's money, not a problem. Just don't lose your money, perhaps, is the key thing. So he had Gordon Brown selling off gold in the early 2000s, and weirdly, and to be clear, I mean, I was out in markets at that point, but it's hindsight. Sometimes it's quite clear in hindsight what rang the bell. And it was Gordon Brown selling the gold basically at the bottom. But at that point, I mean, gold was down at you know, $220, $250. It had been $850 20 years before. And people were just saying this is like the most useless investment I've ever seen. So they were selling. We got the US downgrade in 2011. It was the first downgrade. Standard & Poor's took their rating from AAA to AA+, which is kind of semantics, but nonetheless. And that really did renew interest in gold. Suddenly it was, hang on, we kind of thought that these big governments, you know, like their debt was absolutely untouchable. And now they're getting downgraded. To be clear, AA+ is a big story. You know, we would like BB. You know, we had still investment grade, sub-investment grade. We then had Fitch 2 years ago downgrade, and then Moody's most recently downgrade. Moody's is always late to the party. I don't know why, but they are. So that was the US downgrade that sort of gave another spurt to gold. And then inflation got back. That headline is now almost 40 years since the 18% headline. But suddenly during the pandemic, remember the supply chain disruptions, etc. People in America, they were just sending them money, $600. Here, go do what you want. They were going and spending it. and suddenly inflation is rearing its head. And to be clear, this was happening the world over, but there was an interesting point there in 2023 where US inflation was 9.1 and ours was 7.2. We actually had a lower inflation rate than the US. And that's partly because we didn't do helicopter money. You know, we weren't throwing literally trillions and trillions of dollars at our populace, partly because we don't have trillions and trillions of dollars to throw at anyone. Well, certain, but let's not go down that road. So inflation then rears its massive head. And then this was, I think, instructive in the sense that if you had lived through the previous 20 years, inflation had been pretty benign in developed economies. There had been some spikes, but the spikes had maybe spiked to 3.1 and people were getting panicking. Suddenly they said to folks, hang on a second, inflation really can come back and you're suddenly experiencing it. And for many, many people, this was probably their first real world example of inflation. Suddenly things were just going crazy. We all know the talk around eggs last year in the US election. Truthfully, that wasn't inflation, that was avian flu, but nonetheless, it became a big talking point. And inflation suddenly kind of hit people who for a generation or two had never really experienced inflation. And suddenly they're like, yo, hang on a sec, this is a whole different ballgame. And then the biggest story perhaps was the Russian invasion of Ukraine, February 2022. Why is that so important? What happened when Russia invaded Ukraine is obviously sanctions on Russia. No surprises about that. But the big thing was Russia as a government has dollars in bank accounts around the world. And those dollars got seized. And in fact, they remain seized to date. No one knows what to do with them. It's a couple of $100 million. No one's quite sure what to do with them. But Russia, who thought they had a couple of $100 million in the bank, suddenly realized it was gone. The password had been changed. They couldn't log on to their bank account. And Russia thought, not fun. But so did everybody else. China, who is not an aggressive a country, suddenly realized, hang on, we have also got billions and billions of dollars. And those dollars are either in cash or they're in US Treasury notes mostly. But a lot of other economies suddenly thought, hang on, our dollars in a bank account are perhaps not quite as safe as we thought they were. So what's the alternative? Well, gold is the alternative. And central bank buying started, we'll look at some charts in a moment. It started about 15 years ago. It started accelerating in about 2016, most notably from China and bits of Europe, Turkey, some other economies as well, Vietnam, but it has fundamentally accelerated since the invasion of Ukraine. And economies that are not involved, but Vietnam's been buying more gold. Now, is Vietnam an aggressor? No, but Vietnam also suddenly realizes that someone can change the password on their bank account. And whatever dollars they have are suddenly not their dollars. And central banks the world over have suddenly realized this. Here's a weird fact. Our central bank hasn't bought gold in 24 years. I don't know why. I have no idea why, but we haven't been buying gold at all. We have reserves, but we keep our reserves mostly in dollars. We buy dollars in the open market, and that's where our reserves sit. We have some gold reserves, but nothing added to it in the last 2 decades or change. So it's a fundamental shift in the terms of how central bankers, who pretty much for 40 odd years before that had taken the view that, yeah, we'll hold some gold for historic reasons, but really we want to hold US dollars, we want to hold US Treasury notes, and that is far superior. We get a yield. Gold doesn't give you a yield. A US Treasury note can give you whatever, 2, 3, 4, 5% yield, whatever that case may be. Dollars themselves don't pay a yield, but a weakening currency. So it was a fundamental shift that had come on the back of a bunch of others, most notably concerns around US debt, concerns around inflation, and suddenly gold is back in the picture. So that then raises a question, and I put this up right up front and early because this is on everyone's minds around what's the target for gold? Where can gold go? And truthfully, you know, if you're looking at a company and you want to value it, you can make assumptions and you can determine a fair value into the future. Your assumptions could be wrong in that what you think happens doesn't happen. The company doesn't as good or whatever the case may be. Your assumptions could be vastly over optimistic. Valuations could change. There's a lot that could dent those assumptions. But essentially, a company is the future cash flows. So how do you value gold when there is no future cash flow? In fact, gold has a negative yield because you need to store it somewhere, and that storage costs money. Now, if you've got 1 or 2 Kruger rands, you can hide it with the Rice Krispies. But if you're a central banker, or even ABSA, who've got the new gold ETF, and they've got billions of rands worth of assets in that, they've got to put it somewhere, and there's a cost incurred. So gold effectively gives you a negative yield as something when you hold it. But important saying, and I can't remember who said it. I meant to Google, but I forgot. In times of prosperity and the like, you want to return on capital. In times of concern, you want to return of capital. I don't want my money to grow. I just want it to come back to me, which is why we had negative interest rates in the late teens and into the early 20s. Why? Well, because you weren't looking for return, you were looking for security. So you gave your money to some Swiss bank, and a year later you gave them $100, and a year later they gave you back $99, and you thought, winner, winner, chicken dinner. Weird, but you knew you were getting your money back because it was safe. Hence the negative yields that we saw in bond markets. So valuing gold is nigh on impossible, but that doesn't stop loads of folks. So we've talked inflation, we talked central bank buying. You can see there the central bank buying, 50s and 60s, giant buying. This is post Bretton Woods, so this is the US government buying en masse. And then US steps off Bretton Woods, and we see massive selling, pretty much all the way through 20 years, net sellers, and then sort of 90s into 2010, aggressive net selling. That includes obviously Gordon Brown around 2000, but you can see a lot of selling. And then you can see first green year, 2010, and pretty much we've been going green since then. This is just central bank purchases. So central banks have come to the party and they are buying. We've got uncertainty. Gold's that I want a return of my capital. I want the return of the capital, not on the capital. So things such as tariffs, wars, inflation, and sanctions all bother central bankers and investors and everybody else in between. Tariffs are inflationary. End of story. That's what Jerome Powell said last night at the FOMC press conference. They are seeing signs of inflation moving higher in the US, and that's at a base 10% tariff, not at the Liberation Day tariffs from the 2nd of April. That'll add. Beyond just tariffs, just onshoring. I mean, can you make an iPhone in America? Sure. Can you make it for the same price that Foxconn can make it in China? Not a chance. So instead of paying $1,200 for an iPhone, Americans are going to pay, I don't know, what does it cost? I mean, 2,000, 3,000, 4,000. It's going to be inflationary. So we've got inflation. We've got wars currently going on left, right, and center. We've got tariffs, and we've got those sanctions and those threat of sanctions. I mean, Iran is sanctioned and is probably not using the formal banking system. But if they were, you could be pretty sure that that money is being yanked. Now, part of the problem is, like, they took the Russian money, but they don't know what to do with it. The argument is give it to Ukraine, but at this point in time, it's just sitting in a bank account somewhere, and hopefully no one changes that password. But we've got the ingredients. There is, of course, a flip side. Higher prices, jewelry demand collapses. We're seeing a lot of jewelry move into PGMs, platinum most notably. Gold is 3,400, platinum's 1,300. It was 950, 850 just a month or two ago. So you get substitution. You do get price sensitivity from central banks. I chat with the World Gold Council most quarters when they do their report, and they say, yeah, central banks are sensitive to a price, but that sensitivity goes away. So when gold spiked to 3,450 last Friday, you probably didn't see any central banks buying. They're like, yo, no, man, that's a terrifying price. But if gold stays at 3,400, in a month or 6 or 12, they're going to be, well, hey, we kind of got used to this. It's kind of like the drip effect. So there is some sensitivity in that regard. And then there's markets, for example, in India. What do you do to save? You buy gold. They sell gold in India by the gram. And people will buy it, and then when they need cash, they'll go and sell it. But again, there's price sensitivity to that. There's also demand. Those fancy computers that NVIDIA makes, the GPUs, they've got some gold in them, but it's a very, very small amount. And again, a look for substitution. Now, what else could we use instead of gold to make it happen? But the short answer is that what works for gold is that uncertainty, and what we're seeing is it there. The world, I mean, it's a brave statement to say. I would say, so I was at school during the 80s, and we had the Cold War, and that was a period of heightened uncertainty. Since then, the uncertainty largely seems to have faded away by and large, but it is back again. And I appreciate sitting here in the southern tip of Africa, the wars and tariffs and G7s and all that stuff happening feels very remote and not our issue. But on a planet, we have uncertainty. We absolutely do. That, like we haven't seen probably since the end of the Cold War in November 1989 when the Berlin Wall came down. So we've got all of that ingredient there. So then someone like Goldman Sachs, never shy to put their name to something. This was back in April, said gold 4,500 by the end of the year is possible. Now, I don't know. That's a very brave but wheezy statement. Oh, this is going to happen. Maybe. Well, then is it going to happen or not? I mean, like, put your head in the block or don't. But like, don't like put somebody else's head in the block. Anyway, that really got everyone talking, saying that there is actually that gold can get to 4,500 by the end of this year. To be clear, there's like 6 months and some change left. And I tried to get the logic behind this. I couldn't. So then I chatted with Meryl Pick. She head of equity research, Old Mutual Investment Group. And I chatted with her, and she's like, oh yeah, no, Old Mutual Investment Group has a target, and she gave me the logic behind it. And then my doofus suddenly goes to sleep on me. So she went and looked at previous periods in this century where gold has absolutely rallied, and ran the numbers, and it essentially gets to it. So she looks at the 2001 trough to peak in May 06, from 256 to 725, 182% over 5 years. 2008 trough to the September 11 peak. That was just August was when the US got downgraded. Gold spiked and came back. 166 over 3 years, more than double. If we then just take that simplistically and take the pandemic trough and take that to a peak, we're getting somewhere between 4,350 to 4,600 for gold. When I say to her, how long will that take? She's not Goldman Sachs. She says, I don't know. But if the question that you put to me is gold going to 4,500? The answer is yes. If you ask me when, I don't know. I mean, it could happen. It could happen this month. It could happen this year. It could happen this decade. It might only happen in my lifetime. But a 4,500 gold price is not off the books at all. We also got to remember that gold miners are not doing many more greenfields. They're doing some brownfields, in other words, they'll go and rehabilitate an old mine, etc. But they're not doing so. Goldfields opened a mine in Chile just recently. Took 13 years from discovery to production. 13 years. And that's about the average to get a big mine up and going. So if you're the CEO of a gold mine, you're looking at this and you're thinking 13 years. I've got a 10-year tenure perhaps left on my service. I've got 10 years and it's not going to be finished. So I got 10 years of costs and I'm not going to get the benefit. And that's assuming things don't overrun. That's assuming we're seeing challenges that some of the miners are having in some of the Central African countries. Truthfully, Chile hasn't been very friendly to goldfields either when they had completed the mine. So we're just not seeing greenfield production. Whereas there's not a lot of new gold. There is a lot of recycling. I got married 25 years ago. The wedding ring is 12x more. Yeah, unfortunately, I was I poor or was I a cheapskate? So it was a cheap wedding ring. Maybe I was both. Anyway, it's up. I mean, that was $250 gold in April of 2000 when I got married, and now it's 3,400 gold. Yeah. Anyway, so where is gold going? Higher. In a straight line? No. Over what time frame? I don't know. I don't know. And no one knows. We don't know. And to be clear, one of the key things with gold is that it's counter-cyclical, uncorrelated in theory, right? Markets are going to hell. You all buy gold because it's safe. Not quite. And we saw this in the pandemic. We saw it in the 08 sell-off. What happens is when the world is going to hell, you want to turn stuff into cash. You sell stuff that's easy to sell. Gold. You can't sell property. That takes time. You got to phone an estate agent, get viewers, people, courts. You sell what you can turn into cash quickly. So in the immediate event of a crisis event, and I put crisis in inverted commas, in an immediate event of that, gold will sell off too. But then shortly thereafter, or at some point thereafter, it recovers and goes. So, is my prediction for higher gold? Yes, absolutely it is. And truthfully, it is pretty much everyone's prediction for higher gold. So this is just a collection of predictions of gold prices for 24, 25, 6, 7, and then 2030. It is about 20 or 30 odd individuals and banks, JP Morgan and everyone else. JP Morgan says 6,000 by 2030. We've got David Hunter. I don't know who David Hunter is, but he says 10,000. Jim Richards says the same. In fact, he says 10,000 by next year. You can see that the low estimates are sort of 2.5, and then we start getting, but there's a lot of stuff around that 3.5, which is where we are right now. So I think, and I hate predictions, but I would be brave enough to say that gold is going higher. How much higher and over what time frame, that is more complicated. There's other things, for example, gold overtakes euro as global reserve asset. Now, to be clear, euro was never a very big global reserve asset. If nothing else, it only came to existence in 1999, but still the Europeans are probably quite offended by that. Basel III, which came in post 2009, if you're a bank and you hold gold, you could only count 50% of that gold as a capital adequacy. You can now count, as in July, you can count 100% of it as capital adequacy. But I don't think, so these are not central banks, these are commercial banks. I don't think Standard Bank wants to have a pile of gold, which the price fluctuates. So your capital adequacy is good today, but bad tomorrow. I think Standard Bank wants to hold ZAR because, well, that's the currency they work in. So I don't think that that's going to have a big thing, but it's certainly there at the same time. And you know what? We live in crazy times, so maybe crazy things will happen. So the short answer is gold's going higher. We need to find a place for it in our portfolio. There's an argument for it to be in our portfolio. In an ideal world, gold will track inflation. It'll do what inflation does. And if you look at gold over the long term, that's broadly what it's done. The old theory that an ounce of gold could buy you a suit at Savile Row in 1820, and in 2020 it can still buy you a suit at Savile Row, just tells me that suits cost too much, but the point is there. Again, not in a straight line. That's what matters most. So how do we get gold? We've got a couple of options. We either get the gold itself or we go for the gold miners. Let's look at the gold itself first and foremost. And gold, there's a couple of ways we can do it. We can go onto the JSE and we just buy a gold ETF, GLD from ABSA or ETF GLD, which is One Invest. And the difference is one's slightly cheaper in terms of total expense ratio. Weirdly, the GLD on the JSE was the first gold ETF ever listed. We can go to New York and we can again get GLD, not owned by ABSA, or we can get the IAU, which is the iShares Gold Trust. And again, the IAU, they're both gold, but it's got a slightly smaller expense ratio. I hold both GLD and the ETF GLD, and I also hold some GLD and some IAU in personal portfolios. You can go and get gold coins. Two things with gold coins. Remember, you need to keep it somewhere safe. Safe enough that no one finds it, but not so safe that you can't remember where you hid it. So I don't hold gold coins because I'm not going to get the second part of that statement correct. The problem is, I mean, I went to the SA Mint yesterday, not physically because we live in the future. I went to their website and I get the spot gold price and I multiply it by the Rand dollar spot exchange rate, and they're charging a 12% premium. The SA Mint is charging a 12% premium for a Kruger Rand. I'm like, you've got to be kidding me. Well, then I went to Scoin and the premium was like made 12% look like an amateur. You can buy gold in the JSE. So you can, the code is KR. OST won't do it, but the global market guys will do it for you. And then the reason OST doesn't do it, because it physically settles. So you go and do the purchase, and 3 days later, someone knocks on the door with a bag and says, here's your gold coins. So you can get the physical gold. The problem is those spreads and the costs. I can buy, one of the ETFs. I can get it instantly. I've got no worries about having to remember where I hid it. It's nice, it's clean, it does what it says on the sticker. So nice and easy. That's how we get the gold itself, the physical gold. What about the gold miners? Because there's an important distinction between gold and gold miner. Gold's going to go up by whatever the price is. And if you're buying it in ZAR, then obviously the gold rand price. The miners have a different story. They're busy going along and they're mining gold, but they price takers. In other words, when they sell their gold, they sell it at whatever the market says they'll buy for it. Right now, being a price taker is lacquer. But in a perfect world, you've got a fixed cost, and suddenly the gold price goes up, so your costs stay the same, but your revenue boosts and your profit just goes to the moon. And that's what we've been seeing with gold miners over the last couple of years. It's that leverage effect. And to get an indication of how massive that leverage effect is and how much we're going to start seeing it happen. So I just took the large gold miners on the JSE, Anglo Gold, Harmony, Goldfields, and Pan African. They're all in sustained cost. In other words, what does it cost them in total to mine an ounce of gold? At the end of last year was around 1,650. Some a little more, some a little less, but around 1,650. What did they net income per ounce last year? Around 2,200. In other words, they were making $550 per ounce of gold. That is a record. That was a record year by a long way. Gold mines have doubled in the period, or in some cases tripled or quadrupled, and the gold miners are making an absolute fortune. And that's at the end of the year. Now we sit with gold at around 3,400. Profit per ounce is now 1,750. So that is tripled in 6 months. One caveat, I'm assuming the all-in sustained cost remains stable. Now, it will increase. Of course it will. Inflation, labor costs, ESCOM, etc., etc. The all-in sustained costs will increase, probably high single digit on some mines, maybe low double digit, depending on the depth that you're going down. Folks like, for example, Pan African went and bought a mine in the middle of nowhere. When I say that, literally, the mine is 1,500 kilometers outside of Alice, and Alice is in the middle of nowhere. So this is really in the sticks. And it's actually a high cost mine. But they're like, you know what, 3,500 gold price, high cost mine, don't mind. But it does push their all-in sustained cost up. It does mean that leverage effect on gold miners is absolutely cranking it. However, the short answer is, this isn't a great insight that I discovered yesterday and no one else knows. Everyone who looks at gold stocks knows this, hence we've seen what's happening to the gold stocks. The move that we were seeing earlier this year was not based on the end of 24 numbers, it was based on gold going well through. I mean, by the end of the year, gold was already, last year was above 2,200. So the investors saw it coming. So what's going to happen? We've had price appreciation. I think we can get more. I don't think we're going to see miners double and triple in the next year or two if gold, even if it goes to 5,000 or 4.5 or whatever the case may be. What we are going to get is bumper dividends. Man, they're going to throw cash at us. AngloGold Ashanti has already said we're going to do a quarterly dividend that will be half of our free cash flow and a minimum of 50 cents. Of course, that's a pinky promise that 50 cents one day will go away when gold goes down. But for now, AngloGold Ashanti is promising you a 50 US cent dividend guaranteed, and then half of free cash flow going forward. Those are giant numbers. The problem is they're also going out and buying things. So Pan African bought that mine in Australia. AngloGold Ashanti bought a mine up in Egypt. What upset me with that is they bought it with shares, not cash, because shares are a perpetual claim. They issued new shares for the mine, whereas cash, you pay it off once, and they are currently printing cash. Harmony's buying a copper mine in Australia. Quick fun fact, in South Africa, when you mine gold, your byproduct is usually uranium. In the rest of the world, when you mine gold, your byproduct is usually copper. Now, uranium, when you're a South African gold miner, you got uranium, you go and sell it to someone, they give you $100 a pound, you think you're doing great because it's free money, essentially. Ditto with copper. You're going to get whatever, $5 a pound on your copper, but essentially it's free money. But Barrick Gold, the Barrick Gold, whose code on the New York Stock Exchange was gold, changed to Barrick Mining, and their code is now B. Why? Because they're going copper and gold. And they're saying, copper is a big part of the future. Copper is. I mean, copper is the best conductor of electricity. Nothing you can do about that. It's in the periodic table. You cannot dispute the periodic table. My science teacher reminded me that every double period on a Friday. And he was right, I mean, to be clear. But what it tells us is, if we are the energy transition, renewable energy, all of that, there is copper. There is copper left, right, and center. Copper and ultimately chrome / steel, but certainly copper. So we're seeing some of them, such as Barrick Gold, such as Harmony, essentially pivot a bit and say, hey, let's go get ourselves some copper at the same time. I'm not convinced by the Harmony deal, because they say, well, these are deep mines and, well, 1,700 meters, which for Australia is deep. For South Africa is it's like not even halfway down yet. We can do deep mining. The trick is when you go down deep and you bring up gold, that ounce of gold is worth $3,500. That ounce of copper is worth $10. But I'm assuming Harmony ran the numbers. I mean, surely. I mean, like, again, I can't be the one to have discovered the flaw in their model. We are seeing some brownfields. In other words, they go back to old mines, they reopen them, they get them going. Pan-African, the Barberton mine, is a mine that is 140, 150 years old, 140, and they just basically finding new areas that they can use. It's brownfield. We are seeing very little greenfield anywhere in the world. There's a bit happening in Papua New Guinea, Harmony's involved there, but the challenges are immense. To be clear, we have mined the easy gold. When we found gold in South Africa in the 1880s, you were panning in a river and you bring a little bit of gold. Now you got to go 4Ks down. We have found the easy gold on planet Earth. I remember when Harmony announced the Papua New Guinea acquisition, probably 16 or 17 years ago, and Google Earth was quite new. So I went to Google Earth and I put in the coordinates, and you can basically just see jungle. And then you like get the topography to see the height, and you realize, oh, it's mountains and jungle, and there's gold there. Maybe we should just leave the gold there. Anyway, Harmony says we can get to it, but the cost. I mean, you got to get. I mean, first thing you got to do is get a clear a site for your helicopter. Then you got to put a road, then power, then water. Then you got to build a little town, then a big town. I mean, et cetera, et cetera. So we are seeing very, very little production. That is bullish for gold. Absolutely, it is. The lack of greenfields coming through is definitely bullish for gold. What worries me about gold miners is, so I hold AngloGold Ashanti. They got a primary New York listing that's relatively new, and they recently been included in the Russell indices. They are the undervalued one, and I also hold Sibanye-Stillwater. Although they started as a gold company, the mines that Gold Fields didn't want. They've then got platinum. They then got palladium. So they've got gold. They're also going into lithium and battery tech. They also own just over half of DRD. At this point, Sibanye is more a PGM miner, and truthfully, I hold it for PGMs. The gold was just like, hey, look at that, you're making money there too. Fancy that. What worries me about gold miners is at some point, they're going to start doing some silly things. They're going to start saying, you know, how can we do better? What can we spend our money on, etc. So, is it too late to buy? I don't think so. I don't think it's too late to buy gold. I don't think it's too late to buy gold miners. I would wait for a pullback on gold miners before I jumped in. Absolutely, I would. I wouldn't necessarily go buy top prices, but expect more in dividends than price appreciation. Can gold miners double from here? Sure, but not in the speed they did it back in Feb. So our miners in the cost curve, right at the bottom is PanAf, DRD, but there's challenges there. So if you look at the pure miners, it's Pan-African, it's Harmony, AngloGold, Harmony, and then AngloGold and Gold Fields towards the top end. But that top end's about the difference. You know, when gold's at 2,000 and $100 of all-in sustained cost is a difference. And gold's at 3,400. I mean, look, it's different. It absolutely is. But it kind of gets lost in the edging. So it almost becomes more important of what's the head office bill, because that head office bill can negate that all-in sustained cost in 2 minutes flat. Yeah. So globally, we are bottom to mid. Folks like Barrick are slightly higher up. Some of the others. I mean, PanAf is one of the lowest cost gold mines in the world. If you're looking for a true low-cost gold mine, and a key point to an Pan-African Resources rather is they had a hedge in place, which they finally unwound in, I think, end of Feb, and that at the February gold price, that earned them an extra 50 million ZAR a month. because they'd sold gold at a way lower price. So they'd done it because they needed capital. So they needed to, the lenders said, we need you to secure some revenue, so sell gold forward. So they had done that. That hedge is now over. So not that PanAf was the cheapest, but they had a cap on some of their production. That cap is gone. And at February gold prices, that was worth 600 million ZAR to them every year. At current prices, it's probably worth a couple of billion ZAR to them every year. So I'm looking more for dividends than price appreciation. I'm also looking to when do we sell? I'm going to come to constructing the portfolio in a moment. But what are the things that are worrying me or will worry me about gold miners? Oops, wrong button. Overpaying at the top. It works and then it doesn't want to work. In other words, doing crazy deals at the top. So I don't know, someone decides to buy Pan-African. It's a great little mine. Let's say AngloGold Ashanti says, I want to buy Pan-African. It's a great, I mean, but you got to pay what, a 30% premium, etc., etc. So suddenly you're buying at a highly elevated price and you're paying a surcharge on a highly elevated price. And that elevated price is the gold price is up at record levels and the Pan-African share price is at record levels. And now you throw a premium on top. That's fine if everything keeps going up at a nice clip, but a lot can go wrong. So I'm watching the deals very carefully. As I said, the deal that Pan-African did in Australia was small enough, and most of it is waste. In other words, it is basically mining mine dumps again, which is what DRD does. The Egyptian deal that AngloGold Ashanti did, I thought they paid a fair price. It's a really, really good asset. I did worry that they'd used shares rather than cash. Harmony going into copper, I don't know. I mean, in a sense, I like my gold miners to be more pure gold miners than not. And I own Sibanye, which is not. But to me, I worry about that. And I understand that it's a byproduct and I get all of that. But if you want a pure gold play, to me, it's either going to be Pan, Goldfields, or AngloGold Ashanti in the local space. One thing to watch, and I had a long conversation with Chantal Marx from F&B about this, safety starts slipping. As I said, back in the 80s, safety just wasn't a consideration. It's a horrible thing to say, but the executives weren't concerned about the workers as far as they were. I mean, if you've been to the hostels around Johannesburg with the mine workers, I mean, the stories are horrific. There was no concern. People died. It's like, just get more workers. That has changed. Fundamentally, it has, and safety has significantly improved. A slipping of safety shows a poor culture, not at mine level, at head office level, because that's where culture comes from. So I think if we start seeing safety concerns, they report, I think is it LFR or LTR? They report that with their results. If we see that number start slipping out, I got questions around the executive team. I'm worried that they're now out there spending all their bonuses and not running their business as they should. When things are tight, and you're efficient and every penny counts and this, and then you're making more money than you know what to do. And it's like, you know what, I'm going to sleep in, I'll get to work at lunchtime, I'll have champagne for tea, et cetera, et cetera. So I'm watching safety. And that, as I said, I credit Chantal Marx with it. She said that safety is what she's watching as well, because it shows around culture. Gold price falling. I'm not worried about gold price falling. I'm worried about gold price cratering. Every time gold looks a little bit weak, I put up my brave little hand and say it's going back to 2,850, maybe 3,000, and it hears me and goes back up again. But I mean, I think that if that chart which I showed right at the beginning, I'll come back to it a whole bunch later, that shows a strong support around 2,850, 3,000 on gold. So we could see a 20% sell-off. Absolutely, we could. My sense is that's not to panic, because all the drivers of gold, those uncertainties are listed, haven't gone away. So that actually gives opportunity to it. And then all-in sustained costs rising well ahead of inflation. Again, that shows, that shows a lack of business nuance at the head office. They're getting lazy. I appreciate there is inflation. I appreciate big costs are, for example, labor, and labor want more money. Of course they do. They want better lives. I appreciate that Eskom's a big cost, and you can put your renewable energy in, but you still got a whole lot of Eskom. but I'm keeping a close eye on that at all points in time. That would then see a gold price fall. Pretty much the gold miners mine and sell. So if you look at the PGM miners, they were stockpile. So weirdly, the PGM miners always have inventories. I'm like, what's your inventory? So I asked the CEO one time, and he awkwardly says, it's platinum. I'm like, oh, of course. I don't know. What did I think it was? Baked beans? I don't know. It was platinum. So the PGM guys would try and get clever. The gold miners just form a salad. They just form a salad. So if that happens, it will be seen in the price going down. Yeah. I think there's less risk of that from mining. I think there's more risk of that from gold that's out there. Yeah, it goes back to recycling, and we can see it in the PGM space right now. Recycling of PGMs is just not happening at current prices. You know, a catalytic converter, there's maybe $80 in it, but at the peak there were $300. Math works at 300, not at 80. At 3,400, man, people are recycling stuff. Wedding rings. It takes a lot of wedding rings, but I mean, you know what? If they are gold, that is the real McCoy. So that's what I'm watching to concern me. At the moment, we're seeing deals. They're not huge. They're not massively overpaying. I mean, they're paying a premium, but it's not too bad. Safety is still there. All-in sustained costs are holding on. The mining sector is fine at this point in time, in my view. The big risk is that peace breaks out. Yeah, so I do. The problem is the picks and shovels people. Master Drilling is a great example. The Omnia explosives is that they're in they're not in gold. So Master Drilling is about 20% of there is gold. A lot of it's copper. Copper is the bigger number. So it's there, but it's more a basket of commodities. If we were seeing a commodity rally, picks and shovels. But at the moment, the only real rally happening is in gold. I mean, yes, PGMs have moved a bit, oil's moving higher, copper's a bit, but the big rally, not so much. So they kind of more when the sector's moving because they're not specific enough. As opposed to, quick aside, in AI, the picks and shovels is easy, right? You can go and buy NVIDIA, or you could go down the chain and buy TSMC, or you could go down the chain further and buy ASML. There's a direct linkage in all of those as picks and shovels. So how much gold? And I promise you, if you ask 200 people, you'll get 300 answers. There is no definitive point in gold. I went back and read a whole lot of literature from the 80s because that was the sort of the heyday of the gold bulls, or the gold price was falling, and they didn't realize there was 30 years of pain and suffering. And even reading a whole lot of literature now, the general consensus is that you're looking for around a 10 to 20% exposure in a portfolio to gold. If you were at the presentation which Adrian Seville did last year on his hummingbird portfolio, I think he calls it, he talks around having a minimum 5%, but ideally a target 10% weight of pure gold, not gold miner. I would make, for me, my 10 to 20% is mines and gold itself, blend of both, and that number is going to change. Importantly, your expectation for gold should be zero growth after inflation. So let's say there's 10% inflation over the next decade. Well, no, because 10% inflation would spike gold. Let's say there's 2% inflation over the next decade. Gold should then return you that 2%. But I don't think we're in a perfect world at the moment. As I say, I think we're in a very uncertain world and a world fraught with fears and who knows what comes next. Yeah, I was listening to an American podcast this morning, and they're like, you know, the Democrats are so bad at the moment that they're going to lose the next presidential election, which means we get Trump 3.0. It won't be Trump, it'll be someone else, and they might make tariffs look like a walk in the park. I mean, we just don't know what's out there. So it's about 10 to 20% in total. There's other things. I mean, if you've got Satrix Resi, right now the Satrix Resi is 50%, in fact, more than 50% of gold miners. And that's the beauty of an ETF. As the gold miners carry on growing, it will be more and more in your Satrix Resi. So I hold Satrix Resi in my tax-free account, and it's doing great because of, well, it's now more than half of gold. And if I go back 5 years ago, it was probably 10% gold and mostly PGMs. And weirdly, Sasol, but we won't talk about Sasol. That's painful. The top 40 is about 15%, probably closer to 13%. So, you know, gold is just having its day again in all of those indices. So my target in my portfolio is 15%. That number changes as gold changes, as markets change. I didn't check what it is today. I know I am above target. I'm not stressing when I'm above target. I just go new money, which is either deposits or dividends. I just put somewhere else. If I'm below 15%, new money being dividends or cash deposits would go into some gold, and I split it evenly between minor and the actual physical, well, in my case, ETFs. So I'm targeting about 15, which is low. Perhaps some folks would say, gold, compelling story, going to 5,000. Shouldn't we have a whole lot more? Sure, but maybe I'm wrong. And then, I mean, when I put the NVIDIA chart over gold, gold's just a little wiggle at the bottom while NVIDIA goes to the moon. I mean, there's other stuff out there. And we are what I hope, and maybe these are famous last words, we are what I hope is in a particularly precarious point, and that in a year or so, things would have eased off a little bit. But like, no more wars, perhaps, as would be a nice place to start. Maybe some certainty around tariffs. That 90-day extension Trump gave us ends in like 2 weeks, and like, what's going to happen in 2 weeks? To be truthful, no one knows. And when I say no one, I include Trump in that. I mean, we just don't know. There's a chance that things de-escalate over the next year. So that's the gold story. Then there's the Standard Bank structured product. It is the Standard Bank Gold Miners Auto Call to be specific. Structured products, typically fixed term period. In this case, it's a 3-year fixed year term. Interestingly, what it's doing is it's paying you a 13% coupon, semi-annual 6.5%. It is a 3-year product, can be called after every 6 months, and it is tracking the Van Eck Gold Miners ETF, which is basically New York Gold Miners Index. If you're looking for a Gold Miners ETF, it is the Van Eck. They also do a junior gold miners. Be careful of that one. I know it sounds great, but look at the chart on that junior gold miners. It does not done great, but the good old fashioned Van Eck. It closes 26 June, so that's next Thursday. Clock is tick tock, tick tock. And in essence, you buy the product, you've got protected downside. If it closes less than 30% down, you guaranteed your money back. Put it the other way, in 3 years, if it's 31% down, you've lost money. If it's 29% down, you get your capital back. So your capital is protected against a large fall. It's minimum 25,000, and it is in ZAR, so you don't take currency risk, which is important. That's part of the problem with gold, is that if the rand, look, if the rand goes to 40, we're all smiling. If the rand goes to 14, suddenly our gold is looking a little less exciting. And the rand being the rand, either of those are likely. In fact, they're probably both going to happen in our lifetime. And I know 14 sounds crazy, but been there before, got the scars to show it. I like the idea around structured products. They're not for everyone, but I like the concept of them. I like the protection. And as a quick aside, there is a China one, which gives you an enhanced 125% return and 100% capital protection, no questions asked. You can get this if you log on to OST. You can also get it via other brokers. If you phone the call center if you're struggling, 25,000 minimums. The gold one closes next week. The China one is 11 July, Friday. I will be in Durban. It'll be too late. I'll be on the beach. It's weird that we sit in a window where suddenly this barbaric relic, as it was called by Goldman Sachs, who've just now put a 4,500 target on it, is suddenly in the news again. If we suddenly have a breakout of peace and certainty over the next period of time, that would be bearish for gold. But understand the psychology behind these sorts of things. It would be bearish for gold, but there's been a fundamental mind shift in investors, central bankers, and everyone in between, gold miners in there as well. And that'll change more slowly. So if we wake up tomorrow morning and there is peace in the world, Putin has withdrawn his troops, Israel has pulled out of Gaza and out of Iran, and there's just, peace and poppies. I mean, gold's going to fall. It's going to go to, I don't know, it's going to fall, maybe a lot. But the underlying central bank buying is still going to be there. The underlying, look what happened, it can happen again. The underlying worries about inflation. As I said up front, there are folks out there, if you're of the right age in a developed market, you'd never experienced inflation until post-pandemic. Those are going to remain. And then gold just becomes to do boringly what it says in the sticker, which is deliver you an inflation-adjusted return over the long term and give you stability in your portfolio. And that's not a bad thing either. 25 years ago, we had Gordon Brown selling gold, and that was undoubtedly a ringing bell. I think it's going to take a lot to fundamentally change mindsets. And to be clear, Gordon Brown responded 20 years after the peak. He was late to the party. Gold had fallen 65, 70%, 75% before he responded. So even if things were suddenly to break out and be glorious, it's not going to suddenly be the end of gold. It'll change the story. It'll take that 5,000 price target and throw it out the window, but it still has a place in a portfolio, which is weird because 25 years ago when Gordon Brown was selling, I'm like, that's a smart man. I wish he was related. Now I disown him. Different family tree. Lots of Browns in this world. Lots of Browns in this world. In closing, I like it. I'm bullish. That can change, but I think sentiment remains in place, and I think that sentiment is there. Still holding, happy to hold ETFs. Miners, happy to be holding, but keep an eye on the miners. Keep an eye on all-in sustained costs. Keep an eye on big deals. When the big deal happens, don't panic immediately, but wait, because initially everyone loves it, and the market's all excited, and they do rights issues, and they got PowerPoint presentations, and then everyone wakes up to the reality, and things go a little bit pear-shaped and turn south on you. Yes, looking at you, Woolies and Famous Brands, two stocks I used to like until they decided that they wanted to go and waste our money somewhere else. At this point, the bull case remains. It'll change, but gold has changed how people see it to what we were thinking of it 25 years ago. And that perhaps is the key point, that there has been a fundamental shift in how we look at gold as investors. That's me, folks. Next event is 21 July. It's going to be 25 years of lessons for me in the market. Part of it will be thinking Gordon Brown was right. We will be here, but we will be on the other side because here is getting knocked down and jazzed up. I don't know. Stuff is happening. And then August will be Mishimagama, advanced charting. And then we've got more events coming through. Thanks to all of you. I've hit my time, but if there's a question or two, I know Disha wants to play poker, but so I would say if you are moderately optimistic on gold, the structured product works. If you are bearish on gold, stay away from it. If you are very bullish on gold, stay away from it. Yeah, it's going to give you 13%. 13% is nice. AngloGold Ashanti did 13% on one Tuesday last month. Okay, came back, but 13 per annum. So 3 years. So Bitcoin's a digital gold. Short answer, Bitcoin's going to kind of do what gold does. You notice when there's a risk off, Bitcoin falls. When there's a risk on, Bitcoin rises. So Bitcoin is a digital gold of assets. Yes, it is harder to value than gold in of itself. Absolutely. So yeah, I mean, Bitcoin kind of sits there as well. I mean, I've got some Bitcoin in my portfolio. It is, I actually don't know. I can quickly try and run the math. It's maybe a few percentage points, 1.5 perhaps there, but it is a kind of risk on. The difference is that whilst we're starting to see more adoption by traditional finance houses, central bankers are way away. They're going to do the central bank digital coins and the like, but for a central bank outside of Salvador or somewhere to hold Bitcoin, I think we're a long way away from that. In Bitcoin, so yes, I do, and I tell you why. So I bought Bitcoin $8,000, so I'm sitting pretty, and then I did nothing. And then I see all these people on the internet who, like, they get $500 and they buy some Bitcoin, and a while later they get $400 and they buy some Bitcoin. And this one kid's got a target of getting a whole Bitcoin. He's like 17 and he's got like 0.1, and I'm like, man, I want to do that too. So I'm going to start buying some more. Why? Because the point with Bitcoin is that when I was buying it at 8,000, not many people knew about it. When I was mining it, when it was 8 cents a coin, and I was mining it, and I stopped mining because it was slowing down my game. I know we make poor life choices sometimes. But then, to be clear, at 8 cents, I would have sold it at $1 and thought I was a genius, right? At that point, no one knew about it. There's still a significant bunch of folks who just don't know crypto, don't have exposure to it. We saw the introduction of the ETFs last year in the US, and what that suddenly leaps it forward. We've got the Genius Act, which just passed around in the US, still to get through the House. But we're getting that adoption and awareness, and that awareness is growing. And as that awareness grows, it brings more people into it. To me, and to be clear, I'm talking Bitcoin, maybe Ethereum. I'm not interested in the rest. Sure. I mean, look, I mean, there is a world in which you can't access your gold ETF. In that world, you want pumpkin seeds, water, and bullets. Your gold ain't you. You come to me with your gold bar. I'm like, dude, I got pumpkin seeds. Go away. So I don't concern around that. You take account of, well, you don't, because most of them are ETFs rather than ETNs. ABSA physically has the gold in a vault in London. So the gold is physically there. Is ABSA going to default on that? Is the government going to steal it? I mean, all of those sort of things, if they're happening, I mean, we're queuing to get into Zimbabwe, right? We've got border post at Bright Bridge we've got to get through. We've got bigger problems. Yeah. So your key thing is what some folks would do, and there's an F&B listed product where you can buy, and then when you get to a coin, you can cash in and get the coin. So you can do what the kid's doing with the Bitcoin, but you do it with gold. I just, you know, Krugerrand's pretty, but I'm going to forget where I headed. I mean, truth, Bob, I'm going to forget where I headed. I lost my earphones today because I put them in a different, cleverer space. Folks, I'm going to park it there because I've run my time. Thank you all very, very much for your time this evening coming through to Rosebank. To everyone on the webcast, appreciate your time. We'll see you again next month. Thanks all.